Today, it feels like the signal-to-noise ratio in macro is worse than ever. Headlines around a potential U.S. Iran deal contradict each other by the hour. And if you're a long-only equity investor these days, it's no surprise that cash levels have spiked because you're waiting for the dust to settle. But instead of trying to decode every geopolitical headline, we are going to focus on the crypto headlines this week because there's been a lot. This is the Digital Asset Summit week in New York City. It is reframing the block space as core infrastructure to deal with tokenization, stablecoins, agentic commerce. We're going to be breaking down the new SEC-CFTC guidance, redefining digital commodities. And we're going to talk about why products like BlackRock's staked ETH ETF are hugely important and why they're reshaping crypto supply and yield dynamics. So let's get into it. Welcome back, everyone, to the Coinbase Markets Podcast. I'm Dave Duong, Global Head of Research at Coinbase, and I am joined by Colin Basco, who every week has to begrudgingly play the part of my right-hand man on the research team. So it's a pretty tough time in markets. I think I don't have to say that. Everyone's probably feeling it. The hardest part right now is that I don't know which headlines are real anymore. And this is really a general macro problem. I don't think it's a crypto problem. This is hitting us in equities, bonds, precious metals. You know, the U.S. seems to be alluding to a deal with Iran. Iran says that there's been no direct or indirect contact with the White House. I don't think either of those two things seems to be entirely true, but I also have no idea trying to separate what is propaganda, what's not. And I don't know what the intentions are anymore from either party. So, you know, if you're a long-only investor in equities right now, I don't think there's anything you can really do, which is probably why we've been seeing these cash levels spike over the last 3 weeks. The Bank of America actually publishes a fund manager survey every month, and it shows that this has probably been the biggest spike that they've seen in quite some time. So if you show the charts, what's been interesting, though, is that crypto has actually been performing pretty well. I would say, if anything, Bitcoin has been fairly resilient. And in large part, I don't think this is a huge surprise, right? Like, part of this has to do with the fact that Bitcoin sold off a lot in, late, I should say early October, up through probably January. It kind of suffered again during the events of February 5th. And now, actually, what's interesting is that it's been moving in line with the dollar, which looks a little bit more like kind of a safe haven, which I dispute. I don't think that's what's happening with the dollar. I think it's just the fact that if you turn to oil prices, well, oil prices are actually, basically weakening right now. And because oil is priced in dollars, like if you have to, spend more to kind of send oil around the world, and oil itself is kind of more expensive, well, then the dollar is going to naturally strengthen. So it has been interesting, though, that over the last 3 to 4 months, Bitcoin has been trending a lot more with the dollar. Typically, it should be moving antithetical for that. But turning it over to what's been happening on the crypto side, well, we have the Digital Asset Summit in New York City, which is kicked off this week. I think it's showcasing a pretty decisive shift in institutional sentiment. No big surprise to anyone who's been listening to our podcast, or if you've been even watching the space. The big themes coming out of this summit seem to be tokenization, stablecoins. A new one, which we're going to touch on a little bit, is AI agents. And, this is not new per se. I mean, we have talked about it on this podcast. We've written about it. We put it in our Crypto Market Outlook 2026, for example. But still, like, the development of agentic commerce, I think, is still a newish one. And there have been a few developments on that side. We had talked about X402 on Coinbase. It's a standard for AI agents to kind of pay each other. There's another one that kind of came out, which is called the Machine Payments Protocol. So it seems that these are now competing standards to kind of build out the agentic AI commerce kind of world. It'll be interesting to see how this develops, because I don't think this is going to be something that's going to reap rewards in the immediate term. Probably it's going to take a few years to kind of see this grow and build out. But this is the beginning of it. And super interesting technology, given that AI, of course, has been pervasive in all our lives more recently. Tokenization. Also a massive kind of theme, but not one that's entirely new anymore. This has been kind of building since 2021. Even Coinbase Asset Management, for anyone who doesn't know, Coinbase Asset Management is a separate team from Coinbase. This is the arm that we bought out from One River back in the day. And they launched a tokenized version of their Bitcoin yield fund on the Base network. This is public information, by the way, so not saying anything that you can't find online. But they're using the ERC 3643 standard, and this utilizes a compliant permission on-chain infrastructure to actually target institutional and credit investors. So something that's, I think a lot of people have talked about, given the amount of Bitcoin that a lot of institutions are sitting on these days. But another big headline is Hyperliquid, and this isn't a surprise. We've been talking about Hyperliquid a lot recently. They've been launching a ton of stuff from perps on precious metals. They just launched a perp on the S&P 500. So I don't know, Colin, I know that you've been paying attention to this. I know that a lot of people have been kind of pivoting their attention now to away from just crypto purely and into other stuff. Any thoughts on this launch?
Yeah, ever since October 10th, I think the interest in a lot of altcoins has come down significantly, but Hyperliquid has been one of the exceptions. And I think it's pretty interesting to see Hyperliquid list an S&P product. And I think it's even more important that S&P said yes. To me, I think that's the biggest story. An official S&P license is a pretty big deal. It's a big branding, legal, data quality validation that a lot of crypto venues simply just usually, I think most people would expect that wouldn't be able to get done. But obviously Hyperliquid is able to get it done. It's starting to look a lot less like a crypto-only perp venue. And really, I think that was one of the major sort of bull cases that we wrote about in our coverage of Hyperliquid, is that it is expanding beyond crypto-only beta, which allows it to generate fees and attract a lot of volume in times like this, where you're seeing a slump in crypto interest in general. So I think for Hyperliquid, their strategy to be able to incorporate other asset futures other than crypto has definitely served them well, especially in terms of their hype token as well. And also, I think the real bull case here isn't just one S&P contract. I think it's the precedent that more licensed benchmark products can come on chain, which will drive more builder stake demand, more fee-related buy and burn flow over time. And eventually that should accrue to the token holders of Hype as well. So I think this is a huge development for crypto in general, but specifically for Hyperliquid that was able to get that contract done.
Yeah, I think this is going to become a super interesting topic, because it's not just about Hyperliquid and the S&P. I mean, this is starting to become ubiquitous. There was this headline that if you're watching on YouTube, you can kind of see it. This is not a newer headline anymore, because NASDAQ has been saying this. Now NYSE is saying that they want to partner with Securitize to develop a 24/7 tokenized securities platform. So it seems like this is the way the world's going. We're going towards tokenized equities, stablecoin settlement. I mean, this is why at DAS right now, these are the big topics. People are trying to figure out how to get a piece of this. And of course, Coinbase were involved in this too. I should kind of point that out. I'm not trying to hide anything. Like Coinbase has been very clear that we also want to offer tokenized equities at some point. So I think that this is going to become a major theme over the next few months. I'm not sure how all of it's going to play out. My own view is that net liquidity is going to be improved, price discovery is going to be supportive. We're going to see that gap in the weekend start to be closed off. Maybe you'll see less proxy use of Bitcoin, which is kind of the role it's been playing over nights and weekends. But kind of turning to the crypto side of things, regulatory issues have been a pretty big theme in terms of being an overhang that's kind of prevented crypto from going more broad. We just saw a headline last week that the SEC and CFTC is issuing a landmark joint interpretation, which is going to establish a formal 5-part token taxonomy. And this is hugely important, because we recently did the survey with EY Parthenon. And, if you are looking for it, it's on our website right now, the Coinbase Research website. And this is the 2026 Institutional Digital Assets Survey, where we do this every year to kind of ask people, hey, what do you see for the market? Are you worried? Do you think that things are going to go stronger, more? Are you going to increase your allocations? We had a question about regulation. And we asked, where do you see the biggest opportunities and concerns on this side of things? What's interesting is that on a question where we kind of asked about regulatory uncertainty, 2/3 of institutional respondents, 66%, flagged regulatory uncertainty as one of their primary concerns when allocating digital assets. And if you ask them, like, break it down, like, what are your your biggest concerns when it comes down to regulation? The biggest part, 78%, say it's market structure. So I think this is a huge issue to kind of talk about, and probably some big relief that we could be seeing from at least some of the major tokens. So Colin, walk us through it. What did the SEC and CFTC say? What does the token taxonomy actually do in terms of providing guidance for how to tackle this space?
Yeah, I think the way to think about this announcement is that it's moving the market from a world where people were constantly pricing in legal ambiguity to a world where at least some of that ambiguity has now been reduced in a more formal way. And in my view, I think that matters a lot more than just the headline optics, because regulatory uncertainty, specifically in crypto, in my opinion, has effectively acted like a valuation discount across the entire sector, especially for institutions for a long period of time that essentially had to run every investment through legal compliance, different investment committees before they were allowed to allocate any capital. And I think that survey that you pulled up explicitly shows how much of a concern it has been for so many institutions. So I think what's important here is that agencies are now not speaking in vague principles. They're actually laying out a taxonomy that's clear. They're giving named examples. And I think that's the real shift. So according to the SEC, the definition of a digital commodity now is basically an asset whose value comes from the functioning of the network itself and ordinary supply and demand dynamics, and not from a claim on a business or from passive rights to someone else's managerial efforts. So now I think the market has a much clearer framework for separating tokens that look like core network assets from tokens that look more like financial claims on the efforts of other people managing a certain network. I think the reason why that matters for markets is because for a long period of time, Bitcoin has been the main enjoyer of what I would call a regulatory clarity premium. And I think that's why you saw a ton of institutions would go with pretty high confidence to Bitcoin relative assets. And so as a result, you've seen a disproportionate amount of institutional capital flowing into Bitcoin relative to the rest of the crypto market. But once the SEC will start identifying clearly, like they explicitly named ETH, Solana, Cardano, a bunch of different assets as digital commodities, now that exclusivity, in my opinion, starts to narrow. And so the takeaway is not necessarily that it's going to be bullish for all altcoins, but that they're the sort of regulatory advantage that Bitcoin uniquely had for a long period of time is now no longer as large as it used to be. And now we're going to be able to see a lot of large cap network assets being able to at least get more institutional either attraction or interest in general. So in my view, I think that lowers the tail risk, that investors will start to think more in terms of looking at some of these altcoins. We're already seeing Bitcoin dominance starting to come down. It's below the 200-day and 50-day moving average. Not calling for a new altcoin season, but at least it does show that some more institutional capital is flowing to altcoins. That being said, in terms of price action, I don't think my stance has really shifted. I think everything is going to rely on Bitcoin to be in a bull trend. I don't think idiosyncratic breakouts in altcoins versus Bitcoin are going to have much longevity in terms of how far they can go or how high these altcoins can go when Bitcoin is in a slump. And you're also seeing that just based off of the price action response to the news. We did see a lot of like bullish price action in altcoins over the weekend, potentially from people front running the news on this. But all of it ended up getting sold off. A lot of that strength just came down along with Bitcoin. So while I do think it is an important new development in regulatory taxonomy, I don't necessarily think that it's going to be like the key driver for a new altcoin season.
Yeah, I agree with you. I mean, we don't operate in a vacuum, right? There's a lot of things going on in the world, as we kind of alluded to already on this call. So obviously macro factors are important. And I agree with you. I think Bitcoin performing well is a precondition to the rest of the crypto complex. It is interesting, though, that if you look at Bitcoin dominance, I mean, we've been kind of seeing it kind of keep inside that range of 58, 60% over the last few months. I think we're testing whether there could be a potential breakout where alts are going to start doing better. And to your point, I thought it was super interesting that the SEC didn't just keep this abstract, right? It could have just said, hey, digital commodities don't grant yield. They can't be a claim on businesses' future profits or assets, blah, 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 blah. Like they are just tied to the programmatic operation of a crypto ecosystem. And if they just did that, that'd be fine. But the fact that they explicitly listed certain assets as digital commodities, I think that's, maybe game changer is too strong a word, but certainly I think it shows that, we can actually have formal interpretation where we can actually say, if we actually want to construct a portfolio, the regulatory clarity premium actually stretches beyond Bitcoin. And I think that's kind of what you're saying. Now that you're seeing this new taxonomy narrow that exclusivity, I mean, what happens in the long term? Because doesn't this kind of offer more availability for people to kind of add these other assets in the portfolio? And like, who do you think this is going to benefit?
Yeah, so I definitely think that from a portfolio allocation perspective, now we can see institutions starting to allocate more capital into some of these altcoins. But that being said, I don't necessarily think it's going to be altcoins broadly. From their framing, it seems like the large cap proof of stake infrastructure names are going to be the ones that are going to be able to pair actual regulatory clarity with real network usage, staking activity, and credible long-term value capture. So I do think that there is a potential for a shift in focus towards utility. I know some people were floating the idea that the idea of digital collectibles being meme coins. So there's one of the 5 components of the digital commodity classification was digital collectibles, and people were floating the idea that meme coins could potentially fall under that as a category. I personally am not a buyer of that as of right now, just given the fact that I kind of look at things through the lens of price action and use that to dictate what I think the market is suggesting. And meme coins as a sector did not break out in response to the news and didn't even really rally much at all. So I don't necessarily think that that is going to be the case. But obviously that can change with further guidance. The SEC explicitly said that the framework was not necessarily fully ratified. Like Congress still has to approve the framework. So it's possible that people are still holding out, or it's also possible that macro is just a dominant driver, which is, in my opinion, the true scenario where just macro is just dictating flows. And given the current macro situation, people probably don't want to allocate too much into meme coins. So I think from that perspective, there are bigger drivers at play, regulatory being probably one of the smaller ones.
Yeah, I think that's a good point. And I kind of want to emphasize what you just said, because I do think that this is a regime shift, but this is not the final word on U.S. crypto law. And that's what the SEC commissioner said. He said that, this is the basis for a more workable approach, but he acknowledges that only Congress can really make this framework durable. So, potentially, like if there is a market structure bill, there could be a safe harbor regime for token launches, a broader statutory reform. But for now, I think that this is still a huge incremental step towards trying to get some of that regulatory clarity. But let's kind of talk about regulated products for a second, because last couple of weeks, there's been a lot going on with regulatory clarity and how it intersects with fund flows. Now, we have this new state ETH ETF. And if you zoom in on Ethereum, the last couple of weeks have been quiet, but it seems like an important turning point for its structural supply and demand picture. Let's kind of talk about it. What's the headline? What did we get on March 12th with BlackRock? And where does this kind of lead us to in terms of your thinking?
Yeah, so BlackRock just recently launched ETHB, which is their ETH staking ETF, and it's the custodian being Coinbase. And I think the cleanest way to think about this story now is that Ethereum is starting to develop a real supply sink dynamic. And in my view, I think that matters because when people talk about supply, they often focus on total supply, but what actually matters for price is the amount of ETH that is economically available to trade. And what we're seeing now is more and more ETH is getting pulled into structures that are designed to hold it, to stake it, and warehouse it rather than actively churn it. And a big part of that story is the ETH ETF from BlackRock, because they're one of the biggest issuers. And what makes ETH be important is not just that it gives institutions another way to buy ETH, but it gives them a better way to buy ETH with yield actually attached, and it's still liquid. And that's pretty different from the spot ETF, which doesn't offer any yield exposure. It only offers price exposure. But once you add staking income, then it's less like a pure beta trade and more like a yield plus a beta play. And in my view, I think that's important because it gives institutions a cleaner way to think about ETH as productive collateral. and not just something that you buy and you hope goes up. So at least it offers one sort of extra stream of income and an additional dimension of investment idea rather than just, buying an asset because it goes up and down. And I think the early flows here are really important because they're quite high. So it was a quite positive sign for demand. And in fact, if you compare ETH inflows for the ETH-B ETF versus the ETH-A ETF, which is a spot ETF from BlackRock, the market actually showed higher demand for income for the yield generating ETF, the new ETH-B ETF, over the spot ETF, the ETH-A ETF. And I think that suggests that institutions really do value the yield component in a meaningful way, especially in a world where crypto assets are, increasingly being compared to other yield generating instruments. We also have like Stretch from MSCR. So the yield component for crypto assets in general, I think, is going to continue to expand into 2026. But back to ETH, in terms of the supply side, I think the story gets even more interesting when you look at some other metrics. So in terms of breaking down the supply of ETH, more than 5% of that supply now sits in digital asset treasuries. And you even got the new headline that Bitmain just added even more ETH to their stack. So I think those vehicles in general, these digital asset treasuries, they're behaving a lot more like strategic balance sheet holders than fast money. And while that means the supply is still technically outstanding, it does lower the velocity of that supply a lot because they're much less responsive to short-term price moves. And I think you can sort of at some point just treat that as non-tradable float. And then as well, you have an additional 30% of ETH supply that's staked. So now essentially you have a growing share of the asset base that's locked in validators. They're not really sitting as immediately tradable float. We have like huge delays in the ETH staking queue. While that can be a positive and a negative thing as well, it does mean that the tradable float for Ethereum is lower. So I think just in general, if you look at all of these different components that are locking up supply, like the digital asset treasuries, you have a large component that's staked. Some of the digital asset treasuries are also, are a component of that are driving some of the staked ETH exposure higher. And then now you have these large ETFs that are also staking. And they're also claiming to try and stake up to 90% of their Ethereum with a relatively conservative liquidity sleeve. And if that's the case, then that could be an extremely high amount of staked ETH that's coming from just the ETFs. As of now, they're around 60% staked. So not quite at that 90% level, but still very high. And they're obviously a huge regulated wrapper. So if other institutions decide to launch staked ETFs as well, that could be a huge driver for driving up the percent of supply that's staked. 30% already is like a huge amount. So I think any component that is able to drive up the supply staked, any of that will just reduce the amount of freely available float for people to trade, which is going to be positive for any amount of demand to be able to push up price.
Yeah, I think that, it's curious to see whether this is going to be sustained because right now ETHB is offering that, temporary 0.12% sponsor fee or 12 bips for institutions on the first $2.5 billion in assets in the first year. Then it's going to revert to 25 basis points or 0.25%. So maybe some of the inflows might be related to that, but I think that doesn't kind of cut down what you were saying. I think that there's clearly strong demand for yield-bearing ETH exposure. So it's not just about price beta anymore. I think that people absolutely want that carry profile in this vehicle. Curious though, like kind of what you were saying about DATs who also kind of stake their ETH. Does this kind of reinforce the core point that you were saying that like more ETH is being moved into these structures designed to kind of hold, stake, warehouse the assets? It's not just about churn anymore, but real demand is coming for like people who can offer like the ability to be productive in some way, shape, or form?
Yeah, I think that's definitely the case. And we do know a lot of digital asset treasuries are staking their ETH, Bitmain being the biggest one. The only thing I would say that's kind of concerning, but also a positive, is that the distribution of DAT supply is primarily skewed in favor of Bitmain. Bitmain holds an overwhelming percentage of that supply as the subset of digital asset treasuries. And from that perspective, it's both a positive and a negative. Just the positive is that they're primarily like it seems very committed to holding ETH and accumulating ETH similar to MSTR. The negative would be if there's any sort of, large liquidation crisis or something that causes them uniquely to have to sell off that ETH. But I think in general, the more positive than negative, given the probabilities of that happening.
Yeah. And obviously, ETH's had things like EIP 1559 for a very long time, dealing with the burn part of the fee. And I think that, ETHCC is coming up fairly soon. We could also hear about new announcements because, they're now on a twice a year cadence of, upgrades to Ethereum. I think they've been thinking long and hard about whether their issuance kind of schedule makes sense, whether they like kind of the way things are structured, some of the fee design kind of questions. I think all this stuff we could be watching for some headlines coming out from that. So we've covered a lot today. There are a lot of things we didn't cover. Colin, you alluded to the strategy, capital plan, the stretch flywheel. You've been a big buyer of Bitcoin more recently. There was also a headline about Aave DAO approving the V4 deployment strategy. We don't have time to cover all of these things, but in the week ahead, I think we're going to try to do more on some of those crypto topics. Obviously, we're going to look at macro as well, because next week we're going to have US flash PMIs, jobless claims. I think that data is still very relevant, in line with the fact that we don't know what the Fed is going to do now because their job is a lot more complicated with energy prices where they are. I think that we got to pay attention, because we're in markets, to how oil and shipping constraints are going to evolve, and whether those flows that we were talking about to ETH and those other ETFs are going to maintain the current trajectory, because I think this is super interesting at the moment. But if you'd like to dig deeper into the charts, scenarios we mentioned, please take a look at our weekly market commentary or other reports as well, or monthly outlook, or our Coinbase positioning report, and all of the other research that we put on our Coinbase institutional research portal. Thanks for everyone who listens to the Coinbase Markets podcast. If you found this helpful, please like and subscribe, leave us a review. Please share with a colleague who's trying to make sense of the current regime. And we will be back with you next week on more about how crypto markets are evolving. Thanks a lot.
All statements and analysis correspond to the date of this recording. This recording is only intended for sophisticated investors. This recording should not be copied, distributed, published, or reproduced in whole or in part. Neither Coinbase nor any of its affiliates make any representation or warranty as to the accuracy or completeness of the statements or any of the information contained in this recording. The views expressed in this recording are not necessarily those of Coinbase. Coinbase is not providing any financial, legal, accounting, or tax advice or recommendations. The receipt of this recording by any listener is not to be taken as a giving of investment advice by Coinbase to that listener. The information in this recording is believed to be current as of the date of this recording and will not be updated or otherwise revised to reflect information that subsequently became available or a change in circumstances after the date of this recording. Investing in cryptocurrency comes with risk. Prior results are not guaranteed, and prior results do not guarantee future performance. The listener should consult their advisors before making any investment decision. Coinbase may have financial interests in or relationships with some of the assets, entities, and/or publications discussed or otherwise referenced in the recording. Any references to third parties, investment strategies, or digital assets do not imply Coinbase endorsement or approval of any third party investment strategies or digital assets or any website or content related thereto.